Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Gold hit over $2,000 an ounce for the first time the week of August 3rd. Joining me to discuss is Juan Artigas. He's the head of research at the World Gold Council to discuss gold supply and demand trends and the sustainability of this run. Juan Carlos, it's great to have you with us. Welcome to Trade Talks.
Thank you so much for having me, Jill. It's a pleasure being here.
Not only did the gold price hit 2,000 this week, total investment demand increased 98% year over year. Are these record-breaking numbers sustainable over time?
Well, in particular, the strength was coming from the investment side, and gold-backed ETFs saw a very, very strong showing. In particular, so far up to July, if we take into account July, investors have bought about $50 billion in gold-backed ETFs around the world, and we track about 90 of those. Now, there has also been strength in coin demand, in particular in Western markets like the US and Europe, but we have seen weakness in consumer demand, in particular jewelry and technology. As you can imagine, the impact of COVID-19 has had not only an effect on incomes, but also the lockdown has prevented people from going to purchase goods and luxury items in particular, right? But what has been really interesting is that in spite of, or perhaps because of the strong rally in the stock market, investors may want to still capture some of that upside, but protect, right? And this is where gold has come in quite handy. Now, we think that there is also some positive momentum going on, right? That is influencing the performance of gold, right? And that is indeed creating these price move, especially over the past month or so. But the fundamental reasons, meaning higher risk combined with very low opportunity cost, namely interest rates, are very supportive of investment demand and probably will structurally change asset allocation.
How does the current price of gold compare to similar highs in the past?
Well, right now, as you mentioned, we've reached a nominal record. Once you adjust for basically inflation and convert to real prices, gold is still below the highs it saw in 2011 and certainly in 1980, where adjusted for inflation, the price of gold would be about $2,800 an ounce. But what is interesting to see as well is in terms of the global financial crisis, the price of gold basically doubled from the onset in 2008 to about 2011, or kind of like late 2011, and it took a couple of years. Now we're only about like 30% of that if you take into account that the global pandemic maybe started around January. And even though, of course, there were still risks in the system, the global COVID pandemic has really exponentiated those concerns amongst investors. And not only that, really kind of like push interest rates to unseen levels in many parts of the world.
Now, according to your data, gold ETFs are on an 8-month positive trend with first half 2020 inflows at record levels, as we discussed, surpassing even central bank buying at its highest. Do you expect this momentum to continue?
Well, there are three factors that we are monitoring there, which I mentioned. Two of them are absolutely fundamental in terms of the relevance for not only short-term dynamics, but long-term dynamics. And that is the higher level of risk and uncertainty that investors are facing, right? Combined with virtually zero interest rates around the world, and it's actually negative in many parts of the world, especially in Europe. So those are two, structural and changes that investors are facing. In addition to that, we have seen, as I mentioned earlier, price momentum that creates additional pushes or upside trends sometimes, or downside trends, right? So from that, you may see a little bit of a consolidation. It can happen, but there are still two very strong fundamental reasons why investors are buying gold-backed ETFs.
And one of the reasons I go back to central bank is a possible impact of monetary policy, including inflation and deflation. Can you explain to the audience that impact that it could have on gold prices?
Absolutely. So gold is often seen as an inflation hedge, but probably the best way to understand it is as a extreme risks to inflationary or deflationary scenarios, to how the price of goods is moving around. So when inflation increased substantially, or at least inflation expectations increase quite a bit, investors tend to use gold to hedge some of that inflation, and therefore historically the price of gold has performed positively quite strongly during that period. Interestingly enough, Oxford Economics conducted a study several years ago analyzing the potential impact of deflation in gold, because we haven't seen deflation hand in basically since the Great Recession in the US. So, but when they did their analysis, they found out that even though cash may still do quite well, gold can still perform better than many other asset classes, because it is still seen as a de facto currency, even if it's not an official currency. So in the extreme scenarios, whether it's really high inflation or deflation, gold may perform well as a hedge. When inflation is within kind of like normal bands, there are other factors that influence performance that are more important. So inflation is not as relevant.
All right, Juan Carlos, and to wrap up here, we've certainly seen the V-shaped recovery in most parts of the stock market. As we look at the economy and the shape that it's eventually going to take to catch up, perhaps we might even go into expansion once we come out to the other side of COVID-19 lockdowns. What's your outlook for the remainder of 2020 and moving forward? Should we get, whether it's a V shape or swoosh, whatever kind of shape you have as the economy plays catch up to that?
And that is really interesting. Of course, we are not necessarily forecasting how the economy is going to recover globally, but what we do have is a tool that can be very useful for investors. We developed a gold valuation framework and constructed a web-based tool called Quorum. Q stands for quantitative and Orum stands for gold. And that tool actually displays various macroeconomic scenarios: a V-shaped recovery, a U-shaped recovery, W-shape. So investors not only can see the ones that exist that were provided by Oxford Economics, but they can customize it and expect their own views. And from that perspective, they can see how gold may perform in these environments, and also analyze at the same time not only the impact of the current macroeconomic environment on investment demand, but also on consumer demand. Which is the dual nature of gold, investment and consumption. As I was saying at the beginning of the call, consumption has been pulling back, and it is important to understand how much of a headwind that can be. Historically, in these types of environments, strength in investment demand has offset that weakness, but of course, it is important to monitor it.
All right, Juan Carlos, thanks for joining us as always.
Thank you so much for having me, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.